The next shoe to drop will be real estate. Hopefully it'll be the last shoe to drop for a while, but I don't necessarily think that's the case. In any event, if it's your first time here, you probably have not heard my premise. My name is Peter Leeds. Nothing in this video is intended as personalized trading advice for you. We have been so far ahead of the game with this stuff at a time when the delusion was at the maximum. When there's a diner trading for hundreds of millions of dollars, might have even been a billion, I don't remember exactly. In New Jersey, a diner trading as a stock, when we had people telling you that there's going to be new highs in the stock market this very year. I've seen people saying, buy the dip in everything, buy the dip, buy the dip. When people are buying real estate in the metaverse, when they're buying real estate in real life, when they can't even afford the houses they're buying. People are paying millions of dollars for NFTs. You're being told that Bitcoin's going much higher when it's trading over $65,000 per. Now everyone's saying what they're seeing is clearly obvious, just like we're going into a recession this year. But the point is, some people were talking about it well ahead of time in the middle of all of this delusion because we saw clearly what was going to happen. Anybody changing their tune and telling you different things now didn't see it coming in the first place, so why believe them? What I said is that it's all going to come down together. That means cryptocurrencies, stocks, even bonds to a certain degree, your retirement savings. The NFTs and altcoins are all going to be treated with realism. I'll even show you exactly what I said. This is a clip from the archives. If things continue to play out as they are playing out right now, the outlook I've been giving you for years now may turn out to be one of the single greatest economic forecasts of all time. What did I tell you? I told you that the curtain would be pulled back. I told you that reality would return to the markets. What markets? Not just the stock market. I'm talking about the real estate market, the bond market, and we're seeing all sorts of cracks in those eggs now. And it was all about when the focus, which kept the attention of the entire world for the last 2 years and 2 months, shifted, when that wasn't such a thing or a concern. There wasn't as much fear involved with it. That's when this delusional market would start to all come down together. It's all going to come down together. Real estate is the one that's starting to crack, and it's just begun, and it's got a long way to go lower. Even inflation is coming down, and in a couple of weeks, you're going to get the December read on inflation. We get to show you the trends on inflation at that point. For many of you, this is your first time here. My name is Peter Leeds, and along with my extraordinary team, we publish one of the most popular financial newsletters of all time. Nothing in this video should be considered as personalized trading advice for you. One of the things I explained to you was that real estate will be affected by the increased interest rates, but it happens on a delay. The very early interest rate increases has already started to factor now, and the bigger increases that follow on later are starting to have their effect now, and there's still more interest rate hikes to come. There's not yet been enough time to factor in all the results of this intentional damage to the economy, and it's not done yet. Plus, that's what I was trying to show you in that video I did about Jerome Powell translated, is to point out how many times he doubled down, tripled down, quadrupled down on the staunch commitment to get inflation rates down to 2%. Plus, we got some more hikes coming up in 2023. This channel is about investing brilliantly. And the way you invest brilliantly, you subscribe to the channel so you can learn everything we're trying to tell you. I want to show you some of the real estate trends that are going to be leading you to understand which way real estate prices are going. Because there's a wealth effect. When your house is worth more, you'll spend more, you're more active in the economy. As you start to see the house prices decline, you'll have a negative wealth effect. You'll be less likely to spend money. And add to that all the inflationary pressures we're facing and this massive debt bomb that's over the heads of every corporation and the federal government and most people across America. Real estate has held up pretty well up until this point, and it's just now starting to show cracks of going to where it was always going to go that I've told you about for a while now. But when you watch how many bidding wars there are for a listing, and you see that number starting to decline, you realize that the market is getting less active, less hot. And when prices start to go down, fear of missing out absolutely vanishes from that market. As soon as prices are not going higher consistently, it's like sunlight to mold or oxygen to cancer. Fear of missing out cannot exist in an environment where house prices are known to be coming down or expected to go lower. You're even seeing the sellers having a little more give in terms of negotiations. And even after the deal's done, they'll be more likely to adjust the deal to make sure it happens. For example, you get the inspection and then you realize you have to redo all the pipes in the house. And the buyer might say, knock $8,000 off the deal that we agreed to for us to close this deal. And the seller, in the old days, go back 6 months, they would say, forget it. There's a line of people trying to buy this house. I'll just go on to the next one. But now you're seeing that the sellers have a little bit more give. They're more willing to accept adjustments to the conditions. And in fact, the buyers themselves are putting more conditions on the deal. For a while there, it was just all cash, no conditions, no inspection, just to land a deal in the middle of a bidding war. Now people are going forward with, I'll buy this house, but I need a full inspection, and I need time to get my financing in order. Those numbers of conditions are increasing. The number of days that a listing is on the market, as that increases, and I'll show you a chart of that as well, that tells you more than just about any other aspect that we're going to look into right now. I'll show you a chart of how many days the average house is on the market before it sells. You can see the gray area on this chart is the world's shortest recession. And then here, more recently, as of the summer, this past summer, May 2022, you're seeing a trend of an increase in how many days a listing is on the market before somebody buys that listing, on average. And as that increases, it shows you that the real estate market is getting less frothy as we speak. This is a chart of the Housing Affordability Index. A lot of the problem is that there was such a low inventory, prices were going higher, and for such a long time we had really low interest rates, making it easier to finance a house, buy a house. But even in that environment, house prices kept going higher, making it more unlikely for people to buy their first house or to sell the house they're in to buy another house. Here's a chart from Trading Economics. Most of these charts are from Trading Economics. This is bank lending rates. As interest rates go higher and as payments for a mortgage increase, as a buyer, you're basically paying more for less house. This is the debt balance of people in terms of mortgages specifically. Not credit cards, not student loans. This is mortgages, the debt balance. This is a chart of household debt to GDP. You'll see it's been falling ever since about February when it was at 80%. Now it's all the way down to 75.6%. So I'm not all doom and gloom. I'll show you where things are good. And United States households have less debt compared to their ability to create value. So that's a trend going in the right direction. People are being more frugal. This is a chart of the U.S. 30-year fixed mortgage. I decided to use a 5-year chart for this so that I could show you something. Most recently, the 30-year fixed mortgage rate declined. Even though it doesn't feel like it, I know, but it had declined. If you go back, it's been a while since mortgage rates were this high. But the thing I always tell you is not about the destination, it's about the speed. Look at how quickly this went from 3% to over 6%. Actually, I had it at 7%. That is a short window of time for anything involved with the economy. That's a very short window of time, a very quick change, and that's why it's going to have even more of a negative effect than if it had taken place over a much longer time. Here's a month-over-month chart of building permits. You may have heard that home builder sentiment is very negative right now and falling, and you can see it in the declining building permits. Here's the chart of the Philly Fed employment numbers. You tell me if you notice anything interesting about the trend in the last month. As I've been explaining to you what happened, we are going to see a pretty good jump in the unemployment rate as a lot of these firings happen and absorb through and process through the economy over time. There's plenty of really big name firings you've heard about, But there's a lot of small businesses that aren't making the headlines on CNBC who are having to lay off people as well, especially during these times of high inflation and more economic uncertainty than we have seen in our lifetimes, basically. This is from Trading Economics. This is the U.S. stock market indices. And I want you to pay attention to this column right here, the year-over-year change. A lot of these names you know, IBM, Amgen, Nike, McDonald's. But then you can see what kind of year they've had. So if you're feeling bad about a stock that you own that's gone down in price, feel bad about a lot of these as well, because there's a lot of people getting hammered because they're on the wrong side of things with the stock market when it was so obviously going to fall off a cliff. Hey, listen, if you own a house and you live in that house, don't worry about price changes. You need to live somewhere. You got to keep the rain off your head. And if your house doubles in price, cuts in half in price, it won't make a difference really. Of course it will if you're refinancing at these higher rates. But beyond that, you need to live somewhere anyways, regardless of what the rates are. You need a house. But the big effect, whether you sell your house and move or not, it is about the shifts that are going to happen in terms of the wealth effect. You may stay in your house, but you may spend less because you see that the price of the house is declining. It's so important to see these things ahead of time. Right now, we've had a small window of time to realize that we're about to see real estate prices come down significantly. So you decide if you believe that, and you decide what that means to you. What moves can you make to land in a better place, because you know ahead of time that real estate prices will come down, in my opinion. None of this is personalized trading advice. We've just happened to be almost spot on the entire way with our premise, which leads up to somewhere that you might not agree with me, is another Great Depression, the greatest depression of all time. But there's lots of reasons why I might be wrong about that, and there's a lot of arguments why maybe we have a soft landing. Maybe we have just a regular recession. And we'll get into it deeper in an upcoming video, which is why you want to be subscribed ahead of time. But if you like this video, you want to encourage us, you want to help us out to make more content like this for you, please consider going to peterleeds.com, join the army. We do everything for you guys.